barrel. The oil prices rebound over 2% after seeing steep declines yesterday. Now, Brent Crude had fallen below the crucial $70 per barrel mark for the first time since December 2021, and on the back of increased demand concerns after OPEC cut its forecast of the global oil demand for 2024 and 2025. In this monthly report, OPEC had said that it expects oil demand to grow by 2.02 million barrels per day in 2024, lower from its earlier growth estimates of 2.11 million barrels per day. So on the back of that, we did see the decline in crude coming in, but today it seems to have rebounded, and it's up 2% now. But US CPI data is also out for the month of August, and overall annual inflation has cooled off to 2.5%, its lowest level since February 2021. Now, this figure is slightly lower than the analyst expectations of 2.6%. However, overall inflation shot by 0.2% on a monthly basis. Meanwhile, the core CPI came in at 3.2%. Well, for that, Arnab of Invesco is joining us as a guest to weigh in on crude and CPI. Hi, Arnab. Welcome to Rush Hour. Arnab, we'll speak about the CPI number first. CPI increased, 0.2% for the month, in line with the Dow Jones consensus that sets the stage for an expected quarter percent point rate cut from the Federal Reserve in the coming week. Now, are there any chances for an outsized rate cut, given the recessionary fears are back, in the US?
Yeah, look, I think, we've, and I personally have been in the 25 bips camp all along. I guess, you should never say never. 50 basis points is possible, but I think, it's pretty unlikely at this stage. The market wasn't pricing 50, was pricing, I think, more like 30 before the CPI. And I think, by most accounts, including my own, the CPI, although the headline number is fine, as you say, the core number is not as good as might have been hoped, and core PCE when it comes out will probably kind of maintain that story. So I think we are looking at a 25 basis point cut. I think the Fed is focusing. It's kind of indicated, and I think it's correct to say that it's shifted the focus of its dual mandate from inflation to jobs and to the labor market. But I think it has to keep one eye on inflation. And so I think that points to 25 basis points. And probably, the fall in oil, speaks to the kind of slowdown in demand that people are worried about. Generally in China and in the world as a whole, with the US now slowing down, UK slowing down, maybe Europe isn't slowing down so much, but it has been slowing down. And even India, although growing still very, very strongly, is showing some signs of deceleration. So all the world's big oil consumers may be slowing down in a somewhat synchronized fashion, causing some concerns about the demand side of the market.
Right. Also, Arnab, while the numbers showed that inflation slowly continued to moderate, housing-related costs remain an issue. The shelter component of CPI, which has about 1/3, weightage in the index, increased 0.5%, accounting for much of the increase in the all items measures. Going forward, is that likely to remain elevated?
Well, look, I think, absolutely, shelter has been a big part in the volatility and the kind of persistence, the stubbornness, let's say, of shelter to come down, inflation to come down as much as and as fast as many people have been hoping, I think is, kind of reflective of the nature of this inflation process, right? It's a very different kind of story than I think we're used to on a normal kind of quote unquote cyclical basis. Possibly it has something to do with COVID, directly and indirectly, right? There's been a big upsurge in immigration, what former President Trump calls an invasion across the southern border. I think that's really overstating it, but there is nevertheless a very strong influx, or has been, of immigrants who are possibly, helping to keep shelter costs more elevated, shelter inflation more elevated than it would otherwise be at this stage in a quote unquote normal cycle, right? So, we do think that a decline in shelter is still around the corner, a more sustained decline. But it is, like many things in this cycle, has been attenuated and extended, right? Because the labor market has been persistently strong, and it looks like even some of the slowing, the softening, maybe as much as half, maybe a little bit less than half of the softening in the labor market owes to labor supply, including possibly immigration, rather than labor demand, which is the usual kind of story as the Fed tightens, right? That demand takes a hit, including job demand for workers. And there's been some of that, but maybe there's been more increase in supply, plus people coming out of the woodwork and back into the labor market.
Right. Also, Arnab, let's move on to crude then. I mean, we do see the crude rebounding, like it's up 2% right now. But coming to the big fall in crude prices, which was as low as $67 a barrel. It was below those levels of $70 a barrel. Now, traders are anticipating a deteriorating demand outlook in China, and also they are anticipating potentially higher supply coming into the market than forecasted so far. At this point, what can stabilize the oil prices, and are there any chances of it falling to $60 a barrel?
I guess, again, you'd never say never. Look, I think, again, it's a very unusual situation. We've had a very divergent recovery since COVID and since reopening around the world. We've had a, kind of much softer than hoped for, much anticipated reopening kind of rebound in China compared to the Western world, India, and many other emerging market countries, right? I think demand is a bit of a concern. It looks like maybe what triggered this kind of overshooting to the downside in the crude oil price was an OPEC demand forecast, which was considerably softer than people in the oil market had perhaps expected, right? And I think that's now sort of underscores the kind of overshooting and the bounce back that you mentioned today. I think bigger picture, the story is, as you say, that OPEC oil producers, despite all the geopolitical tensions and the open conflict in the Middle East and the open conflict in between Russia and Ukraine, actually, because of those conflicts, at least to some degree, the major oil producers, including Russia, including Saudi, because of its desire to diversify the economy, they probably all want to pump more oil rather than, really, or at least, generate more oil revenues than, cut back on oil production and oil supply, as had been the case with geopolitical conflicts affecting the oil market, say in the 70s and early 80s, right, where there were embargoes from the oil producers. Now, if anything, there are sanctions, boycotts and embargoes in a way from some of the oil consumers on a few of one really of the major producers. And of course, the dynamics have also significantly changed because the US is essentially energy independent. And is once again the world's largest producer of crude, so the second largest consumer. So not doing very much maybe for the global oil market, but there's less US demand pressure structurally and cyclically because of the slowdown and potentially impending recession in the US. Less of demand side pressure from the US than in a more kind of upbeat, buoyant part of the economic cycle. So I don't think we're going to have a big collapse in the price of oil, right? The big surges and the big collapses in the price of oil tend to come from the supply side rather than demand side kind of behavior, which in the major economies tends to be a more gradual process than supply shocks.
On that note, we will have to let you go. Thank you so much for joining us today.
If you like this video, then like, share and subscribe to ET Now.